Trading the head and shoulders chart pattern in the common way is to treat it as a reversal pattern, and it's probably ranked as close in popularity as the various triangle patterns that can be on a chart. Now the pattern is named due to the shape that the pattern takes that resembles the head and the shoulders of a human. And there are 3 peaks, with the middle one being the highest and the smaller peaks on each side of the middle peak. Extending the comparison, we have the 4th feature of the pattern, which is called the neckline. It's formed by drawing a line between the 2 depressions between the shoulder and the head. Classical technical analysis defines an uptrend as a series of higher highs and higher lows. And this is what we see here. It's a clear uptrend culminating in the head of the pattern. And the right shoulder suggests a weakening of this uptrend because it is the first lower high in the chart. This weakening is further indicated by a new low at the right neckline that is just barely higher or the same as the prior low. And the pattern of higher highs and higher lows is breaking down, and it suggests that the uptrend is coming to an end. And when a trend ends, it will generally be followed by either a sideways price consolidation or by a trend reversal. In the case of a head and shoulders pattern, the reversal is signaled by the price breaking through the neckline. The neckline of the pattern represents a level of resistance to a downward move in price. So think of it as a resistance level formed by the double bottom inside the head and shoulders formation. Once this resistance level is broken to the downside, it becomes support for the downtrend, and you'll often see price retrace to the neckline before resuming the downtrend. And you want to watch price action at the neckline to see if there will be a failure with this pattern. The neckline also helps us project the size of the move down, which will give you a price target to shoot for. And your price target may not be met, but you're going to have the idea of a potential risk reward for the trade. You can also split the difference of the price target and use that as a place to tighten your stop or scale out of the trade. To find your price target, you measure the distance from the top of the head to the neckline. This distance is then subtracted, in this example, from the neckline where price breaks through to give us a minimum target for the move down. In our image, the distance between the head and the neckline is A, and this is projected down as B, which you will easily see is reached in this reversing move. And the head and shoulders pattern is often further confirmed by volume. The left shoulder will typically have a strong volume, while the volume at the head will be lower because the uptrend is weakening. And the volume at the right shoulder will be weaker, still signaling an end to the trend, while the break through the neckline will come on strong volume. The volume pattern, though, it's secondary, and it's not always going to be there. So rely on the formation of the pattern and the breaking of the neckline to indicate the reversal. And so far, we've only discussed the head and shoulders pattern as indicating a trend reversal from an uptrend to a downtrend. There is also an opposing pattern called the inverse head and shoulders pattern that signals a reversal from a downtrend to an uptrend, and you can even see alternating patterns within a larger time frame consolidation. Now here we have a head and shoulders pattern that is broken to the downside and gives us a target A once the neckline is broken. Price actually retraces to retest the neckline before resuming its downtrend. The downtrend doesn't last long before an inverse head and shoulder is formed. And this is broken to the upside, and measuring the distance from the head to the neckline gives us a target of B, which again, it's reached after a few tests of the neckline. Now the proper way to trade the head and shoulders pattern is to wait for a break of the neckline, which will complete the chart pattern. The problem with this becomes apparent when the size of the head and shoulders pattern is too large. Much of the tradable move could be long gone before the neckline breaks, and even that may not signify a reversal. What if there was a way to front run the neckline break and take advantage of the potential increase in order flow? And here it is. I've added a horizontal line to our first chart that started at the left shoulder. And you can see that price comes close to the horizontal line as it forms the right shoulder. And the good thing about this setup is if the trade fails on the neckline, you are going to be able to get out of the trade with either a very small loss or a tiny profit. Trading the neckline break has you in a losing trade the moment it crosses back over the neckline. And you also have a very well-defined risk point, which is just over the right shoulder. And like all technical analysis patterns, the head and shoulder pattern will not always precede a reversal. The pattern can also fail, and we will typically consider it failed if the price breaks above the right shoulder. When that happens, we're most likely going to have a consolidation or a resume of the uptrend. The latter would be confirmed by a price break above the top of the head, similarly for the inverse head and shoulders. And it can be difficult at times to spot the head and shoulders pattern on a chart because when we look for them, we look in the wrong places. You'll only find these patterns at the end of a trend, so don't bother looking for them during a price consolidation or in a very choppy market. Make sure there was a clear pattern of higher highs and higher lows first. As a chart pattern, identifying them can be subjective, and this is why I prefer to use the daily chart and above for reversal structures such as the head and shoulders. Also, you don't want to force it. Don't squint too hard or try to finesse it too much. When the pattern is there, it is going to be clear as shown in our examples. Reversals can also be indicated by other technical patterns, so don't assume you're going to find a head and shoulders at every reversal. Exercise your eyes and your mind and start looking for head and shoulder patterns on your chart. Once you spot them, make your target projections and see how often they are hit. And you may find this pattern can be a profitable addition to your trading toolkit, or at least provide a strong confirmation for reversals that are signaled by your current trading system.